Good morning, Sanbonani, Dumelang, Kuyamora, to all you people and businesses that make South Africa great. We're about to start our roadshow. I know others will join while we're underway, but it is my great pleasure to welcome you all to Invequity's 2024 Investment Roadshow. Today, we gather to explore the wealth of opportunities in South Africa's economic landscape, particularly under the promising direction of the Government of National Unity. This roadshow is a platform for collaboration, discovery, and innovation aimed at forging partnerships that will drive sustainable growth. We are privileged to have Alex Cook here with us, who will offer a comprehensive exploration of South Africa's economic landscape under the GNU. He will highlight key opportunities and challenges for investors and business leaders while sharing insights on how embracing change and leveraging South Africa's greatest asset, its people, we can unlock new levels of growth and prosperity. Drawing from his extensive experience in financial empowerment initiatives, Alex will also outline strategies to promote financial independence and resilience, inspiring us to transform challenges into opportunities and building a legacy of sustainable success. I encourage each of you to engage actively, ask questions, and take advantage of the knowledge and expertise shared throughout this session. Once again, welcome and thank you. My name is Sipho Kambule, your host for this roadshow. Some housekeeping rules. Please note your questions in our chat section, which will allow for our speakers to respond in due course. Presentations will be shared to all participants after the session. In short, there is no need to take pictures of each slide. Lastly, the restrooms are located near the exits.
If they got the joke, Sipho.
Our agenda is as follows. Myself, Sipho Kambule, with our business update, followed by Alex, founder and CEO of Cinnabar Investment Management. Moving into the investment and portfolio update by Geoff Blount, Invequity's Chief Investment Officer, who will share insights into some of our exciting high impact and green investment options, reflecting our commitment to fostering not only growth, but also sustainability and positive social impact. There will be an opportunity for questions from online, and then closing with a vote of thanks from our Chief Operating Officer, Suhana. Jumping into Invequity's business update, we have the honor to be joined by our board, Executive Chair Tulani, the bubbly boy Dumelo, who we all know well, Brad Green, and Murray, the Signet Group Executive Support. We are also proud to announce the team has grown with a few changes. The business has been fortunate to be led by Brad Green as acting CEO since May, who has spearheaded the creation of our new strategy, brand, and introducing the expansion of the pioneering team with appointments in key positions, a business development manager role held by myself, and a key account manager held by Janet Naidu. This capacity enables Invequity to add more value and assist in streamlining engagement between Invequity and yourselves. This team has been building a better and more inclusive South Africa, supporting transformation since 2016. The brand has also undergone a nip and touch, emerging with a new look, which we believe communicates who we are, what we are, where we are going, and our aspiration to building wealth and bettering Africa. We define ourselves as a conscious investor, investing in firms that have a net positive outcome. Good for people, good for planet, and good for profit. I invite you to visit our website at www.invequity.co.za to explore our new solutions we have designed to enable your business's growth. Furthermore, in response to what the market and our clients need, we have two additional innovative solutions to our portfolio. Impact investment solutions focused on building funds with a specific mandate on driving social, economic, and financial returns. Second, our business strategy solutions, offering a bespoke private equity solution enabling corporates to strategically invest on an arm's length basis with Black ownership for upstream, downstream, or complementary businesses in line with their own growth. So what does that really mean? If you are planning on building your new company strategy, we are here to assist on how we can integrate this solution to enhance your company's growth. As another part of our strategy direction, we have seen the need to develop the Connect to Grow platform because your success is important to us. Thus, when you grow, we grow. Connect to Grow is an Invequity supported framework that allows us to share product and service information both with our clients and about our clients, with the intention of facilitating engagement for supply and client opportunities. You can participate by allowing Invequity to share your company details via signed consent and registering your organization on the B1 Link platform. B1 Link is a B1 SA product, which is currently part of your portfolios. B1 SA has enabled this platform to be operated for Invequity community in a secure and controlled environment. As part of the registration, you will need to upload some supporting documentation. Our lovely Janet Naidu can assist with getting you up to speed. Her details are listed on the slides. Feel free to contact her. That's if she hasn't contacted you yet. Thank you for allowing me to take you through a summary of how our business is growing and finding better ways to serve you. For more information on our solutions, contact myself, sipho@invequity.co.za, or to participate on the Connect to Grow initiative, contact Janet. For queries on fund compliance, governance, contact Daniela. Queries on your investments and finance matters, contact Ziletile. I hope you have found this presentation informative. As we move forward to our next agenda item, please allow me to introduce Alex from Sinapa Investment Management to share on South Africa's economic and investment prospects under the GNU. Alex is the founder and CEO of GCI, Sinapa Investment Management, and WealthBids. With over 2 decades in the financial services industry, he has dedicated his career to fostering financial empowerment and wealth creation. As an ecosystem builder, Alex has developed innovative programs that promote complete financial freedom, aiming to uplift communities through sustainable financial strategies. Recognized as a thought leader in financial planning, Alex translates complex economic challenges into actionable solutions. His approach focuses on building a legacy of financial independence and resilience for South Africa and beyond. Under his leadership, GCI, Sinapa, and WealthBids have become pillars in the financial sector, known for their commitment to client success and community development. I'll now hand over to Alex.
I'm with you, Sipho. Can you see me and hear me?
Yes, we can.
I can
Amazing.
hear you.
Amazing. Those technical gremlins we've all had, so don't stress, Sipho. We've all had them. It's in the time that you were speaking, we went from under 64 people to over 77 people. And if I remember correctly, last year, I think there were only around 70 people joining the webinar when I joined. So we're already a larger group than we were last year. So I think it's amazing. Well done. Great to be with everyone today. And when Geoff asked me to present what I'm going to be presenting, it's probably about probably the most exciting thing I could have been asked to present this morning. And there's a lot to get through. There's a lot of very, very interesting things to discuss, but we're going to try and keep it as on point as possible. I'd encourage everyone just to type questions into the chat, as many as you can, because I'm sure things are going to come to mind throughout the presentation. And as they do, jot them down. And you're probably asking questions that many other people would also want the answers to. So we're going to be discussing the South African economy and then also the investment prospects under the GNU, the Government of National Unity. Before I get started with that, though, I think it would be naive to not take a look at what the global backdrop looks like. And on the tip of all of our tongues is probably the US election. And unlike South Africa, where a different party gets elected in the US, it doesn't really have a massive impact on the growth of the stock market. It doesn't have a massive impact on the economy. The US is going to be spending about $6.1 trillion. Doesn't matter which government party gets in. As it happened, the Republicans got in, Donald Trump got in, and it looks like it's been extremely stimulatory for the market in the short run. But if you take a look at what the growth rate of the S&P has been under various different rulers or presidents, you'll see that whether it's Democrat, whether it's Republican, it's very, very similar. Under the Democrats, the median growth rate has been about 9.3%. Under the Republican, the median growth rate has been about 10.2%. Not massively different. In South Africa, I think there's a potential for there being massive difference. The US at the same time has been fighting two battles. The first battle they've been fighting is the battle of inflation, where in 2022-23, the inflation was very, very worrisome. And they've been steadily fighting to get this inflation down. And you can see they're winning at it. They're actually, I'm going to see if I can get a pointer going here. Pointer options, let's go for a laser pointer. So you can see the inflation is now down to under the 50-year average, which is good. Inflation target is 2%. It looks like they're going to get there relatively soon. The other battle they've been fighting, successfully I might add, is growth. And they've been trending towards a steady growth trajectory very successfully. Despite all the headwinds that have come their way with very high interest rates, and these interest rates are at levels that are well above the past 10-year average, they've managed to grow their economy by over 2%. And when you contrast that to what we've been growing our economy by, I think you're going to be surprised. So they've had this strong growth. They've had this high inflation. The inflation has now been coming down. And on the back of that inflation coming down, the expectations are for interest rates to come down further. So you can see interest rates peaked at about, and this is now the 10-year government bond, which is a good indicator for interest rates in the US. It's come down from over 5% to today it was about 4.3%. But the expectations going forward by all parties are that future interest rates are going to be lower. Now, when these future interest rates lower, it's going to act as a massive tailwind to think of it as tidal wave, just pushing the economy forward. But if you push the US economy forward, you end up pushing the entire world's economy forward. So this is good news. It's a very good news story for us. So what's this meant for global markets? It's been stimulatory. But it's been stimulatory mainly for the US. The US markets this year to date have gone up by over 24%. All other markets have general markets have gone up by less than that. South Africa, as an isolated part of the emerging market, has actually beaten this. In dollar terms, we've beaten what the MSCI USA index has done. So we're going to a bit more on that a touch later. Now, let's get down to the GNU and let's look at what our prospects are. Because there have been a lot of things that have happened this year. I mean, the Olympics happened, Tatiana won a gold medal. We had Eskom that managed to keep the lights on for, it's well over 200 days now. It's amazing. That alone is going to stimulate our economy. But then we had these elections, and the elections resulted in almost a Goldilocks outcome, where effectively the ANC has retained power, even though they haven't got majority. And the implications of this are quite profound. And the world believes this because we can see what's happened to the stock market. The stock market acts as an amazing sentiment indicator, where if the stock market goes up massively, it doesn't necessarily mean that much has changed yet, but they feel things are going to change. And you can see this year to date, we're up by about 31%. If you take a look at what the S&P has done in dollars, it's done about 23%. All right, so significantly above the S&P. But if you look back over the past decade, we are still significantly behind what the S&P has done. We're about 7%, 8% behind what the S&P has done per year. So that's a significant underperformance. Funnily enough, if you look back 10 years before that, we significantly outperformed the S&P. And it's not coincidental. When we look at numbers we're going to look at just now, you'll understand why we outperformed the S&P back then and why we've been underperforming the S&P significantly over the past 10 years. So the whole story hangs together very, very well. This is more good sentiment indicator, where the Rand has gone from 1944, we went down to under 1780, and then we bottomed out at about 1708, and it's currently sitting at about 1810, right? 1810. And there's a very good chance that it's going to appreciate again from these levels. Why? Because our risk-free rate of return is significantly higher than our trading partners' risk-free rate of return. You invest into a government long bond in the US, you get about 4.5%. You invest into a government long bond here, you're getting about double that. So global investors could very well put more money into our economy if they feel the GNU is sustainable, and we'll see that Rand strengthen. So markets are telling us two things. They're telling us that they're pricing in a cyclical economic recovery. And we're seeing this because inflation's falling, interest rates are being cut. We saw the New Zealand Reserve Bank cut interest rates this morning. They cut by 50 basis points. We're also seeing a commodity cycle recover. So that's happening. And then on top of this, a GNU dividend is being priced in. And this GNU dividend, think of it as it's what the world is expecting the results of this GNU to be. And let's just take a look at what some of these results could be. And this is almost a wish list, but this is a wish list for investors. And this is the first one where we might get real and also perceived. Perception is very important. Improvement in state efficiencies and competency. We might get deregulation, in other words, removal of red tape, structural reforms, an end of support for inefficient SOEs, and an efficient management of cash within those SOEs. We could get proper roadmaps to resolve water, energy, transportation, SOEs, and service delivery crises. We know these are big issues. And when we look at what the breadbasket of the country is, it's Gauteng. The Gauteng is still the most troubled province in the entire country. We need to get Gauteng right. And it's the most difficult one to get right because the corruption is so deep. We may also get a more competent and efficient government. Corruption and prosecution of offenders might be more dealt with better. And then the rollout of promised infrastructural programs might happen. And just some anecdotal evidence there. I was speaking with a person this morning, and they help guide a crane business. And this crane business, accounts for about 80% of the number of cranes in South Africa. And the number of cranes on the skyline is a very good indicator as to what the economic activity is within that economy. Now, from 2016 until pre-election, they were about 60% down on volume from the 2016 level in terms of cranes deployed. From post GNU, post the elections, they've gone back to 2016 volumes in 6 months. So that's an extremely healthy indicator. People are actually putting money back into the economy, which is really, really encouraging. It's starting to happen, guys. So what could a GNU dividend look like? What kind of boost could this give to the economy? And let's look back to the 10 years before 2000. So before 2000, 1990 to 2000, this is us finding our feet, recovering from apartheid. The average annual growth rate was 1.64%. We created about 500,000 jobs. We lost about 530,000 jobs. So we went net backwards. It was not good. Roll on 10 years, and we have a government that is extremely responsible. We have a finance minister that doesn't go and spend money willy-nilly. And our government debt actually remained relatively intact. At the same time, we created 1 million jobs. We lost 806,000 jobs. So net, very, very positive. And if we can head back towards that kind of Goldilocks era in this GNU period, we might see this happen again. There, the average growth rate was 3.5%, significantly higher. And when we look at the numbers, some other numbers, you'll see what impact that had and what the impact the following period had on the growth rates of the country, where we only grew by 1.3%. This is now in the Zuma era, state capture. We created 2 million jobs. We lost 1.5 million jobs. So it sounds positive, but it wasn't that positive, because with an average growth rate of only 1.32%, we're actually not growing by enough. And we see this borne out in terms of these numbers. The ones that are of a lot of interest are, first of all, in the 1990 to 2000 era, the rand went backwards from 2.5 to 7.5 to the dollar. From 2000 to 2010, we actually appreciated. So when our growth was strong, when we were doing a lot of the right things, our currency actually appreciated. This can happen again. And we've seen the start of that. 2010 to 2024, we blew out to 1893. We lost a lot of ground. Never mind the all-share index, but that is a sentiment indicator. What I want to focus on is this unemployment rate. The unemployment rate went from 20 to 23.3. 2000 to 2010, a lot more people came onto the job market, but we still kept it relatively intact, right? 2010 to 2024 has been an absolute disaster. We've gone from 24 to 33% unemployment, and a lot of those are youth unemployed, which is horrific. The last thing I'd like to focus on, but the last two things, are this GDP per capita. This is how much is being produced in US dollars per person. 1990, it was 3,000. 2000, pretty much the same, 3,000. By 2010, it had jumped all the way up to $8,000 per capita. Huge jump. Okay, look what's happened in the past 14 years, though. It's been absolutely horrible. We've gone backwards from 8,000 to 6,600. Standard of living has gone backwards. Production has gone backwards. In terms of government debt to GDP, you can see 37, 33, actually pretty responsible. So you could argue that this period, although it wasn't a massive growth period, it set us up very nicely for a strong following decade. 33 to 42, it didn't go out by a huge amount, but the debt to GDP level has ballooned over the past 14 years, from 42 to 74. So a GNU dividend could be flipping amazing if we're able to start replicating this middle patch here. And I believe we can. But there are some massive political risks. The first risk is that there are fractions within the ANC, and that they align with either the MK party or the EFF party, which would not be ideal. The EFF looks like it's collapsing. They're losing a lot of significant role players. The MK party are picking them up. And if they can move past Zuma and get their act together, this could pose a significant risk to destabilizing the country and the GNU. The other risk with the GNU is that there's bickering, where they start fighting and disagreeing over every little thing, leading to a potential existential crisis of the GNU being sustained. There are a few things to look out for. So remember that dividend wish list? Keep on checking what we're doing against that dividend wish list. Now, we don't have to get every single one of those right, but if we just get 50% of them right, it's going to result in a massive GNU dividend for the country and for each one of us. They do need some quick wins. The next battleground is going to be local government. And don't be surprised if there's a wild card new political entrant to the market. This could very, very well happen. There are also external risks to this GNU dividend. And I was chatting with Frans the other day, Frans Cornier, and he's a guy that gets things right more often than wrong. He got the local election right. He's a political analyst. He got the US election right. He generally gets it right. So I often use him as a sounding board as to what he thinks might happen. And on the tip of everyone's lips, post-Trump getting into power, was AGOA, African Growth and Opportunity Act. And this could be massively impacted by Trump coming into power. And he said, no, that's not the risk, Alex, that's not the risk. That only accounts for about 2% of our total exports. It's relatively small. He said a bigger thing is the South African Review Act. I didn't even know what the South African Review Act was. But the South African Review Act is an act that the US has that assesses whether South Africa poses a national security threat to the US. Which sounds bizarre. If South Africa posing a national security risk to the US. And we might think this is silly, but it's not. Because we've got some big names who are busy saying some big things. Elise Stefanik, the new US ambassador to the US, to the United Nations, expressed some disgust. Her words were disgust, quote unquote, at South Africans' actions regarding the International Criminal Court and Iran, even describing them as anti-Semitic. So that's big. Then we had this chap, Michael Waltz. He's a national security advisor who has been a key proponent of the South African Review Act and has been pushing the narrative that South Africa could be a security threat to the US. Then we've had this man, Marco Rubio, the Secretary of State, and he's been critical of South Africa's treatment of Taiwan, particularly the forced relocation of Taiwan's Pretoria office to Johannesburg, calling it an international humiliation. So the impact of this on investment flows, on trade relations, on financial support could be significant for South Africa, a lot more so than AGOA. So take a look at how this unfolds and take a look at our actions regarding those topics. So the odds are that the GNU is going to result in good news for all of us. But I just implore all of us from a portfolio construction point of view. So we look at things from two different ways. Most of us have got most of our businesses here. Most of the people we employ are here. Most of the opportunity we have is here. So we have a large South African asset if we're running a business here. From a portfolio point of view, so just capital that you have available in your own name or capital you have on your balance sheet, think of yourself as an alien. And if you were an alien and you were sitting on Mars and you're looking at this beautiful blue and green planet, and you had your Martian kids next to you and all your Martian wealth underneath your arms, where would you put your Martian wealth? You wouldn't put it on the southern tip of one landmass of one continent of this beautiful blue and green planet. You'd probably spread it around. So when the rand does strengthen significantly, it's a great opportunity to diversify globally, not because things aren't going to be great here, just because there's so much opportunity globally as well. So that's from a portfolio construction point of view. I would like to just change tact slightly, and I'd like to talk about what our biggest opportunity is. And our biggest opportunity, and I know Invequity is passionate about this. We've been clients of Invequity. I think we were one of the earlier clients. I think we've been with Invequity for about 8 or 9 years. And I know that Invequity are passionate about what we think our biggest opportunity is. But before we get to that, I want to show you what our GDP looks like. Our GDP is about $419 billion, and it's made up of a number of things. But in terms of goods exported, exports account for about 25.8% of our GDP. So it's quite a significant number. And we know where it comes from. It comes from a lot of minerals. They make up the majority of our exports: gems and precious metals, ore, slag and ash, mineral fuels, iron, steel, etc. But then we have services. Services only make up 7.5% of our exports. 7.5% of our exports. So put that in numbers. Services only account, and amongst the services sector, these are them. So things like travel services, transportation, other business services, computer information services. It accounts for a very, very small portion of our exports. And in terms of dollar value, it's minute. It's only about $32 billion. So with this GNU, with this tailwind of GNU, with the GNU dividend happening, and it is busy happening, gauged by the number of cranes that are on the skyline, it is busy happening. Hopefully with an improved delivery of service to our people. And with that all happening, hopefully our people become our largest asset. And I think as a nation, we've got to start understanding how to leverage that greatest asset to our greatest benefit. How do we educate our greatest asset and export their skills, not by shipping them overseas, but by having them work in South Africa, from South Africa overseas, and have that create a massive tidal wave of export and foreign currency coming into our country. So that could be enormous. But I can tell you, we're not looking after our greatest asset. We're not looking after our greatest asset because even if they do get employed, they're not actually looking after themselves very well from a financial perspective. So this is a ship we can turn around. By exporting more of our greatest asset, we can turn this unemployment ship around. But at the same time, we need to protect our people once they are employed and then post-employment. And this sort of brings me to one of our passions. One of our passions where we're looking to address a few big problems that have surfaced in the country, and they've actually surfaced globally as well. Because what we have in place for our people's citizens is not working. Over the past 30, 40 years, we've had a steady move from a defined benefit contribution scheme towards a defined contribution benefit scheme. So back in the day, you worked for a company and you worked there for 40 years, the end of your 40 years career. You had professional trustees managing your pension fund. You had professional asset managers making sure that pension fund grew. And then you received an income for the rest of your life, increasing by inflation until the day you died. Roll on 40 years, and that defined benefit scheme became very risky for employers. So they moved away from defined benefit towards defined contribution. What we effectively did is we put the onus of responsibility into the hands of each individual, where they had to act as their own professional trustee to make sure they accumulated enough money to one day live off, or to make sure that they made their right investment decisions themselves. They get guided, but it's effectively up to the individual to make the right investment decisions. And we're essentially asking individuals to be as professional as those trustees were, which is just it's not fair. And it's not working, as evidenced by the social grants. We now have 27 million social grants that we're giving out every single month. It's phenomenal. And what we have is a financially disempowered nation. The whole nation is disempowered. And this doesn't matter what level of income you're at. We deal with people on a daily basis. And even those high earners are disempowered because they're also not able to do the same job that a trustee was doing for them. The one thing's for sure is that government's not going to solve this. Government's not going to solve this problem. It's up to us. It's up to us to solve this problem. We've taken a step to solving it. And what I want to introduce you to is something we've done. And the idea behind this is to hopefully plant some seeds as to what you could also do to help solve other problems within South Africa. So the Financial Freedom Program is designed to empower people to achieve financial freedom. And it's offered by one of our group companies called WealthBit. And it looks to address society's biggest stresses. Now, if you look, and this is a lot of these studies have been done. This one's done by PwC, gets done annually. And they look at what the biggest stresses to society are. You've got health concerns, relationship concerns, job concerns, and the overarching concern is financial or money matters. And this is across the board, high earners and low earners. They are stressed about this. I was once with a good friend of mine on the Nice Lagoon, and she was paddling, and I like older people. She was about 30 years older than me, because older people are wise. They've just been around for longer than we have. And she was exceptionally wise. And she said, Alex, relationships fall apart for one of two reasons: sex and money. And what I've seen over the past 25 years is that relationships fall apart for one of those two reasons. The sex part, I can't do much about, but the money side, we can certainly impact. So we look to address in the program two societal problems. The first is there's a distinct lack of financial literacy. And once again, it doesn't matter whether the person is highly educated or not educated, high earner or low earner. There's a lack of financial literacy within our society. And the second big problem is people have got no one to turn to. They don't know who to turn to. They feel embarrassed. Or they've approached an advisor at some stage and they've received a product sale, so they don't know who to trust. So we put together a program, and I'm going to share what the software looks like that we've been developing over the past 8 years. And then I'll show you what the program looks like. Once again, it's with the idea of planting seeds as to what you could do to make a big difference within South Africa.
In just a couple of minutes, you'll get a quick understanding of exactly how to plan for your financial future and financial success within WealthBit.
Not sure it's showing on the video screen.
The main thing that we wanted to help people with is visualizing and
So it sounds like I didn't share. Let's try hitting the share button. Okay, it's up, Geoff.
There we go. Great.
Yeah.
Thank you.
Okay. We all do our technical glitch for the day. That was mine.
In just a couple of minutes, you'll get a quick understanding of exactly how to plan for your financial future and financial success within WealthBit. So as we built the platform, the main thing that we wanted to help people with is visualizing and understanding their financial future. Understanding exactly how each decision that they make leads to either a better or worse outcome. This is critically important because conceptualizing large numbers or numbers that are far in the future is very abstract and difficult to reason about. But when it becomes visual, it becomes easy to understand. And when it's easy to understand, it's easier to make decisions and, more importantly, to stick with those decisions. So just for a bit of context, what you're seeing right now is the main dashboard or main plan that you would have if you start using WealthBit. So there's a capital chart, shows your capital over time based on your investments, your income, your withdrawal from investments. All of these things are taken into consideration, along with complicated tax models and all of the legislation regarding different assets to show you the projection. Similarly, we have an income chart to show you how your income will ebb and flow over time. You can also turn on your expenses to see expenses as well as your gross income, which will also show you taxes over time. So what I'm going to do is quickly run down here, show you that there's a retirement budget as well. So for this profile that I've set up, we're targeting 26,000 income in retirement, and we're quite short on that, which is something that we're going to look at to fix. Next, at the bottom, you'll see everything from assets, cash flow events, budgets, and liabilities. And this is really where you can set up all of the elements that make up your current financial life. So this individual is set up with a budget of earning about 45,000. They're withdrawing some money from their assets because they need to withdraw that little bit of extra to actually get to the net income that they're targeting. And the current expenses are 28,000 plus some contributions that they're making to their assets as well, and liability repayments. So this is a case that we quite often see where someone is both contributing to investments and withdrawing from investments and still has debt and it kind of puts them in a cycle where they're not really moving forward in their financial freedom. So to show you how you can actually go about planning, we'll jump into a new scenario. So scenario planning in our platform allows you to create a comparative scenario that allows you to add and make decisions and see how that compares to your current plan. So we're going to start off by making a couple key changes. The first thing we're going to do, since this person is already in debt, is we're going to remove this contribution to this money market for the time being. And once we've done this, that'll open up a little bit of cash in the budget. If we go over, you'll see that we're in a better position because of that. And so things are starting to look better. And let's say we use that bit of extra cash that we were contributing, and we actually pay off one of our liabilities faster. So in this case, we're going to target the credit card first because of the high interest rate here. So let's say we're able to pay off this credit card, right? Now, we've already started making these tweaks, and for the moment, it looks like we're in a worse situation, but that'll change in just a moment. Now we're in a net positive here, right? Where we can see that we have lower liabilities, repayments, we're not withdrawing from our assets anymore, and things are starting to turn around. Now, let's say for the next couple of months, we roll that 2,000 Rand that we were paying towards a credit card into this personal repayment as well, so that we can squash it faster and we get rid of this debt, right? So this is what a debt-free life in this scenario looks like. We'll swap back over to the budget, and we'll see the calcs having adjusted. Now, there's quite a bit of extra room in the budget, suddenly because of this. And what a lot of people are tempted to do at this point is they are saving this money off of their debts that they no longer have, and then they just end up spending that money. But we're going to make the smart decision here and actually invest the surplus of our salary now into our discretionary assets. And this will show you what that does to the picture. So here you can see things are looking very, very different to the way that they were looking just a couple of moments ago. So if we swap over to the income chart, you'll see that we've added on a couple years of sustained income in retirement just because of the fact that we got rid of debt and we're reinvesting that money. Now, additionally, we might say, okay, let's add a unit trust, right? Because the money right now would be probably going into the money market, but let's be very specific here. So we'll not start off with any value, but we'll add that kind of 3,000 contribution into the unit trust. And once we do that, then our picture changes dramatically again. And so the picture has gone from only having about 1.3 million at retirement in today's terms. If we switch that over to future value, it'll be about 10 million, to in future value terms having 30 million, or in today's terms, 4 million. So that is a significantly improved position as opposed to the position that we would have found ourselves in. Once we've done this, there might be some other things that we might want to do, right? So something like planning for holidays and all of those. And in these cases, we still want to be able to live life. So what we're going to put in here is an event to plan for a holiday. And let's say we want to spend about 60,000 from the age of 31 all the way up until the age of 51, right? And we want to do this every year because that's important to us. Now, what Wealthbit allows you to do is actually add this event, and it will handle all of the calcs in the background, try to feed that from your budget and your income that you're earning as a salary that you've input, and it's going to try and really fill this, and if it can't, it'll actually start withdrawing from your investments. And so here you can see, just by making that one change, we've put ourselves in a worse position again. And this is really an illustration of the power of having a platform and a tool in your hands where you can see how decisions actually impact your future. It's very easy to just be in a position and think like, cool, I'll just go on holiday and I'll just do this thing and that thing and the other, without really understanding what's happening to your financial future and what is at stake. The purpose of the platform is to allow you to make better decisions. It doesn't mean that you shouldn't go on holidays or enjoy life now, but it just means that you need to make decisions intentionally and have the data at your fingertips in order to make the best decisions for you and the future that you ultimately want.
So that's that platform, and it took us about 8 years to develop, and we have about 30,000 individuals in the system, and it's great. But what we realize is it's not effective enough. So what I asked the company of last year is, I said, can we do something different? Can we wrap this software up into a program? And the program will use the software, but it needs to address these two societal problems for more people. We need to get to a lot of people if we're going to make an impact. So we wrapped it up into a coaching program, and the coaching program looks like this. First of all, we do financial workshops for staff, and we actually do them on a monthly basis, and they teach something. They might teach budgeting, it might teach about asset allocation, it might teach about different financial products. But at the end of these workshops, people they feel empowered and they have something they can action straight away. The second thing is we give them access to WealthBit. And this is where we import their data from their provident fund and their pension funds. So when they log on, it's real data. And we then roll out a communications plan to the company. We then set up coordinated sessions, because what we found is that people tend not to take action without a coach. So we set up, and these are not long coaching sessions, they're 15 to 30-minute coaching sessions, but it's a personal session where a person can share their story with another highly qualified person. And that person gives them 5 golden rules and gives them 3 ways to implement those golden rules. And these are ubiquitous rules. Doesn't matter whether the person's earning a lot of money or a little bit of money. The rules are ubiquitous. And then we give HR a dashboard to show them what the financial stress is within their organization and how it's changing over time. So it's very important that we see financial stress going down over time. So this is how we're looking to empower people, how we're looking to help people become financially free, and very importantly, financially sustainable. Because if our individuals are financially sustainable, it means they're not going to become state dependent, which means there can be more money to spend back in the country, which then becomes a positive feedback cycle. But in terms of the takeaway message from today's chat, is that it really is up to us as business leaders to help drive something forward. And we've got to give the GNU a little bit of time to work. We can see that a couple of things are happening. We've got to admit, a couple of things are happening. Even the most pessimistic of people that I encounter are saying they are seeing a couple of green shoots. And I think more will happen if we give it time to work. There is an enormous amount of cash on balance sheets right now. I know. There's a lot. As of 2017, there's about 1.4 trillion. I understand there's now about 3 trillions worth of capital on balance sheet, and we need to start putting that to work. There's evidence that it's starting to happen, and that crane provider is probably about the best evidence that things are starting to happen, and that is mainly in Gauteng, which is the breadbasket of the country. And then we need to think about ways to leverage our greatest asset. Our greatest asset is our people. We've got to figure out ways to leverage that greatest asset globally. We've got one of the most beautiful countries in the world. It's ridiculous that tourism isn't one of our biggest exports. It's a big export, but it should be one of our biggest. So it's been a pleasure being with you. Geoff, thanks for inviting me. I'm going to wrap up there, and I look forward to questions at the end. I will be in the rest of the presentation because I'm very keen to see what Geoff has to chat to us about regarding the portfolio companies. I know we're invested in a number of them, and I think there are 1 or 2 others that Geoff gave us the insight on that also piqued my curiosity. So Geoff, you'll take us away.
Great. Thanks, Alex. That was very interesting. I do hope that we can get to the GNU dividend. The GNU dividend, I think, is not only good for business, but also going to be good for the country and lifting, I suppose, the quality of life for all South Africans. So I'm afraid I'm going to have a bit of a speed date with you. I have 10 investments that I will giving feedback through. And I don't have a lot of time. In fact, I'm having roughly 2.5 minutes per investment to talk about. But before I go in and talk about the investment portfolio, just to give you a quick update on Invequity itself. At the moment, we have just over R1 billion of assets under management. That is sourced from 82 clients across our various funds. We have in excess of over 50 private equity funds. And just to remind you, while the companies I'm going to talk you through, where some of our existing money is placed, as well as the opportunity set I'll take you through, to more or lesser degrees appears in most of the portfolios. Very few of our clients have exactly the same portfolio, and so therefore not every one of our clients has exactly the same investment return or investment allocations. But roughly speaking, of our 1.2 billion rand or so, roughly 600 million is from our clients' trade codes that we've invested in, and the balance is invested in what we've referred to as our transformation outcomes or our qualifying investments. These are the investments that when we send you the drawdown notices and you send us cash every month or cash on an annual basis to maintain the BE compliance nature of the funds. And remember, if we keep our funds BE compliant, it means then that your fund is compliant from a BE ownership perspective. That cash gets allocated into our qualifying investments. Just of interest, our average trade co, in other words, the average client company over the last 4 or 5 years have returned or gone up in value by roughly 21% per annum. Our average qualifying investment has gone up on average about 11% per annum. And in aggregate, the portfolio has gone up about 14% per annum. So we'd like to say that we're great at selecting clients because our client companies have done very well over this period. But we also think that that's not accidental. We think that as our clients' companies boost their BE ownership through our private equity funds, it means that they're more attractive to do business with, and as a result, attract new revenues and new growth opportunities. So today, I'm going to quickly run you through some of our current allocations. Most of these names will be familiar to you. We've either fed back to you at advisory board meetings or previous roadshows. I'm going to talk about some of our new opportunities, and then more excitingly, I want to talk about some of our opportunities in the green sustainability space. So starting off, as I said, the speed date now begins. On the companies that you're familiar with, I'll talk very briefly. Starting off with Invequity, you'll recall Invequity is an investment that owns livestock. Basically, it's an asset-owning business. Since we've made that investment over the last 2 years, returns have been in excess of 13%. Just a bit of a heads up, we are in the process of looking to dispose of the livestock and move into other investments, partly because some of the other investments I'm going to take you through today are proving more attractively, but we also just feel on a risk-adjusted basis that we're a little bit uncomfortable with some of the risks that are presenting themselves at the moment in the sector. One of the other investments that you'll be familiar with, I believe that, I think it was last year or the year before, Martin Sweet, I think is online, it spoke about Prime Stars. Prime Stars is one of our most, I think one of our investing companies that we're really in love with. Prime Stars really embodies the fact that you can have fantastic purpose and deliver fantastic impact to society, but you can also still make an attractive investment return. Prime Stars provides education material to young kids from the townships or poor areas, rural areas, and essentially is the private tutor to the public student. Over the last few years, you can see some of the impacts that they've had in terms of the lives that they've impacted. A kid that goes through a Prime Stars a program in maths or science, on average, enjoys a 15% better matric mark than kids that don't go through this program. And this is also just a little bit of a pump for Prime Stars. As we always say, these for our clients, if you have any capital that you want to allocate from a CSI perspective or developmental perspective, please talk to Prime Stars. They're always looking for sponsorship for companies that will sponsor students to go through their various programs. One of our other investing companies that we've had now for just a year and a half is Kwilanga. It's a training business. We acquired it at the start of last year. Kwilanga has trained over 35,000 people. They train people that are employed. So this is about upskilling employed people. Again, we like training. We like the impact that it has, hence the Prime Stars investment, hence the Kwilanga investment. Prime Stars, when we did buy the business, we put it at an enterprise value of the business of 13 million rand. Towards the end of last year, it did go through a little bit of financial stress, and that revenues were down, and so earnings were down slightly. But I'm pleased to say that year to date, for the last 8 months, we've seen turnover pick up nicely. and earnings and profitability starting to rise again. One of the other businesses that you'll be familiar with is Right. Right, as you know, supplies Wi-Fi connectivity through these mesh networks. Well, let's call it as giant Wi-Fi networks, if you want to think about it, into townships and poorer communities. The idea behind Right is to provide uncapped and unthrottled internet to a household for 99 Rand a month. We know that communities where households have access to the internet at these levels typically enjoy a 10 to 15% rise in income in that community as that sponsors business and other opportunities. So Right has, in the last year, we're pleased to say, has moved from proof of concept to commercial rollout. It's now got, I think, in excess of 2,000 or 3,000 households that are commercially paying every month for the services. So it's starting to produce revenue. Obviously, it's pre-profitability. We're very confident in Right's ability to meet its goals. So like in any investment that we've made, where it's pre-revenue, so it's pre-profitability, but it's starting to generate revenue, really your ability to value the business is dependent on the ability for that business to stick to its milestones. So the milestones that we've mapped out for Right over the next few years is to hit roughly 12,000 users by the end of the 25 financial year, 25,000 for 26, 50,000 for 27, and so forth. And if Right hits those, we believe that the business will be worth quite a bit more. In fact, we would put a business valuation just on hitting those targets at 166 million. At the moment, we have the valuation at 58 million. And so as long as it sits with our more conservative rollout target of 15,000 next year, 30,000 the year after, our valuation is intact, but it needs to then up-ramp its rollout to start earning an investment return for us. This is another great business and another high-impact business that can seriously change lives for the communities that it impacts. Just of interest, Right is at the moment in the process of a Series 2 capital raise. Because it's now gone into commerciality, it's able to now go and tap other funders in the market to invest and grow the business. The other current investment that I've often spoken about in the past is Tytech. Tytech is a business that is invested into, its principal asset is Camjet. Again, we like Tytech because of its exposure to the water infrastructure space in South Africa. And over time, Tytech is aiming to build a portfolio of water-related assets in South Africa. So you can now start getting the themes in our portfolios: impact, changing people's lives, education, connectivity, water, infrastructure. Remember, we approach all of these investments from a commercial basis. So while we like the fact that there's impact, or we want the fact that there's impact, we need to see that there's commerciality in that. Camjet does a number of things. From mapping underground pipes to repairing underground sewers to cleaning and unblocking big industrial drains for government, for municipalities, and for the private sector. Just of interest, when we acquired into, and remember the principal asset in Tytech is Camjet. When we acquired into that business, into Tytech, Camjet's turnover was 29 million Rand a year. And it made roughly 6 million Rand EBITDA a year. Last year, revenue was up to 44 million and made an adjusted EBITDA of 7 million. And I'm pleased to say that this year, for the 8 months to October, Tytech's turnover for the 8 months is at 34 million. If you annualize it, that'll probably put us at about a 48, 49 million turnover. And it's going to produce around 9 million Rand of earnings. So again, an investment that we're very pleased with, and over time expect great things from it. So that's the current portfolio. There's one other share for those of you that are on your game that you'll realize is that there's one share that we already invested in, is a company called B1SA. In fact, B1SA is one of the companies that Janet will be introducing you to through the Connect to Grow project, which we're running at Invequity, which we're trying to link both our different client companies together to create an ecosystem, but also link them to the investee companies. The B1 Link platform, one of the flagships of B1SA, is one of the platforms we're using in the Connect to Grow program for our ecosystem partners to engage with each other. But B1SA, as you recall, is a business that focuses on supply chain and let's say optimizing supply chain services. B1SA business itself, which was the original business, really works with companies to optimize their BE score from a procurement perspective. The B1 Link platform is a platform that allows businesses to link to each other via the platform, where a supplier can put all of their details into the platform, from their BE compliance to their statutory information to banking information, and it allows buyers to get that information. So it's a market networking platform. And then last year, when we made the investment into B1SA, it was to acquire a business called Supply Rate. Now, Supply Rate is a business that works with corporates to do risk assessments on their suppliers. So you can start getting the theme or the continuum here. There's a platform that links businesses together to create efficiencies and allow for reporting. There's a business that works with businesses to give a higher BE score through procurement. There's now a firm in that does supply risk assessment to make sure that from a risk perspective, suppliers are appropriately managed and have all the right governance factors in place. And B1SA is in the process of acquiring a credit bureau. We're very excited by this because you can now start seeing, as you're looking at your suppliers, but now you're also looking at your buyers, and you can now start doing credit assessments. So the upshot is that when we invested into B1 Link last year, sorry, B1SA, we valued the business at 71 million rand. There were some delays in the rollout of the B1 Link platform, some cost overruns, but also the ability for B1 Link to start bringing revenue in. And obviously, if you defer your revenue, your cash flow is reduced, and so your DCFs, your discounted cash flow valuations, come down slightly. So we modified our valuation on B1SA down slightly this year. In other words, from our investment last year, we valued at 71. We brought it down to 59 million rand. But with the credit bureau purchase that we'll be investing in, we're looking to allocate a further 15 million rand of equity and pref shares into B1SA to buy the credit bureau business. We believe that when we put notwithstanding the slight devaluation of the cash flows in B1SA due to B1 Link, but we put the new credit business in there, we look at the cost savings that come through that, especially from a tech perspective, and then we also look at the benefits from an integrated supply chain management platform and the ability to cross-sell to the various clients. We think that net for net, this will create strong value for investors. In fact, for the existing shareholders in B1SA, it will re-establish our valuation of last year. And for the new investors, that for the new 15 million rand that we're putting in, half through prefs, half through odds, we think that actually builds an inherent attractive return for them. So B1SA is an old investment, but we're popping up because we think that this business will be infinitely stronger with the acquisition of a credit bureau. And so I'm just doing a time check here. So the next, so that's the current portfolio and a top up of an existing one. Let me run through then some of our new opportunities, and I've got to say every one of them is really cool. And some of them are like more conventional, but here's a business that I think is really exciting. It's called Ferocian. We're acquiring 49% of this business for 5 million rand. So it's actually a relatively small transaction. Typically, our current transactions that we're looking at are between 20 and 30 million rand. 15 to 30 million rand is the space that we like to play in. But Ferocian is a business that's been around for a number of years. But in the last year and a half or 2 years, there's been a big game changer for it, and that's been the introduction of AI. So Ferocian was created by a person out of HR and recruitment and his partner, an anthropologist. And what they thought about was that if people have a social media presence, let's call it social media real estate, whatever platforms you're on, even if you think you're not on a platform, other people will talk about you on that platform, on their platforms. You might have an appearance in the press or the media. You might actually just have a LinkedIn profile. So even if you think you're not in the digital real estate business, we all are. But what they realize is that there must be a clear link between your ability, your presence or persona online and your real life behavioral attributes. And amazingly, there is a strong correlation between that. And so Ferocian is employed by companies to go and do social media risk checks on their employees or their staff or potential potential employees, companies or banks or credit people that are going to extend credit. Lenders want to do profiles. If you want to give someone insurance, you want to check their behavior as a policy holder. And what they found is there's a strong correlation between their risk profile, whether you're a high risk or just a normal person or a low risk person in terms of your social media profile, and your in the workplace, your productivity, your absenteeism, your disruption, how you integrate with teams, staff turnover. So high social risk profile people typically do not make good employees. Now you can imagine, you can extend that. If you are in the unsecured micro-lending space, for example, you want every tool at your disposal to understand the credit worthiness of someone that's borrowing. And in the Ferocian's example case, there's a high degree of correlation between your credit worthiness and your social media risk profile. So this data is invaluable to lenders and insurers and the like. And this is just a snapshot of what a Ferocian, a more in-depth report looks like. But the game changer, as I said, has been the advent of AI. Previously, while these social media risk reports had quite a bit of human intervention, with AI you can systemize the risk scores and do volumes of risk scores, high volumes at a low charge with high impact. So in other words, it's cheap to process it. You can do hundreds of thousands of risk scores, but the value of the data is invaluable to the users. Like any business, although Ferocian has been around a number of years, we really think it's actually been around for 2 years in terms of its current format. It is at a cash flow break-even position. So it's got attractive revenues. It doesn't lose money, and it's not making money. And this investment here will be able to capitalize the business to actually then just accelerate its growth into the marketplace. So we've gone beyond the J curve. And the problem with a business like this is how to value it. We did a whole lot of scenario testing, but we think that we call it our base case, but I would almost call it a conservative case, that this should at least give our investment a 27% IRR, internal rate of return, over the next few years. But it's a bit binary. Either this thing really shoots the lights out, it'll do well, or I think it'll bumble along. But we're very excited by this business. Another business that we're looking at is called Borpa Malema. Borpa is a holding business that is invested in a company, or investing in a company called Maestro. Maestro really is a business that is looking that owns entities in the non-banked financial lending space. It has 3 entities: a company called Alizé, business called Capital Solutions Advisory. It's more an advisory business, and then a business called EMS. I'm not going to dwell on Capital Solutions or EMS. And I'll just unpack Alizé, which we think is where there's a lot of attraction at this stage in the Maestro investment, notwithstanding the opportunities that sit in the other. But this is a 25.1 million investment from Invequity and our clients, of which 20% will be for ordinary shares in Borpa, to acquire 25% of the orders in Borpa, and 20 million of pref shares in Borpa as well. That money will flow to Maestro. Maestro will use some of that for working capital. But a large portion of that is going to be used to boost Alizé Capital's balance sheet. So to give you a feel for what Alizé does, it's a trade finance business, and it lends money to importers. So for example, you want to import 20 million rand of goods, you've got to pay now, but by the time it arrives, it's going to be 3 months. So Alizé puts capital guarantee insurance on it. So most of their loan book is guaranteed. There's a bit of equity risk that they take, which they mitigate through a collateral from the borrowers. But the main advantage here is that Alizé at the moment funds the capital it lends out. It borrows at circa 15%. It lends it out at circa 20%, makes a 5% margin. However, if they can reduce their cost of capital borrowing, it boosts their margins. And so the investment into Borpa will assist in boosting Alizé's balance sheet, which means that it can reduce their cost of capital, the cost of their funding, from 15% and lower. and that would be margin enhancing. Just to give you a sense here at the moment, Alizé is forecast with the capital injection to take its turnover to 60 million rand, which will allow it to lift its earnings from 2.5, 3 million rand up to over 10 million rand. So there's a direct correlation between the equity in the business and the boost in earnings. So I do really feel like I'm on speed date here. We're on the home stretch. Last two investments. I keep saying all of our stuff is really interesting and cool, but these are also cool. The first one is a business called Mandini. Now, in South Africa, we produce 250,000 tons of waste used tires, contract tires every year. Those have a massive impact from a global warming perspective. Government has tried to mandate the recycling of these tires with not great success. However, Mandini is the oldest and longest tire recycling business inside the longest standing tire recycling business in South Africa. They process 40 tons of tires a day. They heat it in a reactor to 800 degrees Celsius, and they break it down into carbon. Well, in fact, I'll show you here: steel, oil, and then gas. All of this is considered green source because it's a recycled product. All of the output has value and they can resell. But the other great thing about Mandini is that on their inputs, when they get their tires from the government waste bureaus or from the mines, they get paid to take the tires away. So not only do you make money on your input, but you make money on your output. And all of this is attractive before we even start talking about carbon credits and the ability for Mandini to generate income from its carbon credits. It's been going for a number of years. And the biggest constraint that currently, apart from two breaks, which was COVID, and there was a fire at their plant, but it's capacity constrained in that it's really short of capital. If they can make it, they can sell it and make margin. And so we're looking at a 30 million rand investment into Mandini for ordinary shares in the business to acquire 15% of the odds in the business. Our valuation on the business is 147 million. That's our base case. We also have a high and a low case. That money will be applied to adding more capex into the business. And the beauty of that is you can produce more capacity, means money drops straight to the bottom line. So again, a high impact business, recycling, green, a great opportunity. Just as an aside, one of the things that we've done in Mandini, and it's actually not dissimilar to what we're doing in Borpa, is when you're a little bit uncertain around the valuation of a business. We said Mandini, for example, is worth 147 million. The business itself believes it's worth a lot more. We said, okay, if in a year or two's time it's worth a lot more, we're happy to buy some of the shares back from us. We'll reduce our shareholding relative to the price of the business, say, in a year's time. But likewise, if the business doesn't perform as promised, we want to buy more shares in the business. And the upshot is that although we start, for example, in Mandini at 15% and in Borpa at 25%, we are able to, if the business is underperformed, we will take our shareholding. In other words, to protect the rand value of our investment. One of the things we're very careful of is to make sure we're as obsessed with what percentage we own in the business, we're actually more obsessed with what is the rand value of that. So that's to protect that. And then the final part of this investment speed date is Jopeka. The problem in South Africa, as you know, is that the municipalities charge R2.60 or more per kilowatt hour. Particularly unreliable, even if Eskom's not load shedding, but the municipality's powers is intermittent or failing. And our current offtake costs, it's fallen off the slide here, current offtake costs for our solar, typically between R1.80 and R2.20 per kilowatt hour. And so therefore, many companies want to put solar onto their facilities, but they don't have the capital to buy the solar. So they enter into an offtake agreement with an asset owner, solar asset owning business. Jopeka is one of those. Jopeka puts the asset on the roof, and they enter into a 10-year offtake agreement to buy power and save money off the solar on the roof. And so in Jopeka, again, like everything that we do, we're offering our clients different ways to access it. Our normal funds can just go and buy a pref share in Jopeka. It's a 10 million pref raise, and that is going into a basket of assets. So that would be installations across a whole lot of different off-takers, and you diversify your risk because you've got you in a basket of solar assets, and you share the revenue across that. Those off-takers pay through a PPA, power purchasing agreement. They buy power from Japika, and then the profits from that will go back to our investors via pref share dividend. But we also know that a number of our clients are actually looking for a solution around energy themselves. So they've got to invest to maintain their BE compliance. Our drawdowns, they've got to invest into one of our qualifying investments. So take that as a given. But in a separate business decision, they realize that they also want to go and buy power through a PPA or a long-term rental agreement with someone that can put a solar on their roof. So as a result, we've introduced via Japika what we call a linked pref share. And essentially what happens is, you think about it, there's two separate transactions. But a client of ours via their private equity fund could invest, say, 5 million rand into Japika pref shares. But that goes into a special purpose vehicle, which puts a 5 million rand energy solution on the client's roof. And in a separate transaction, that same client goes and buys power off that asset, off the asset. So the client is essentially has a PPA agreement with Japika that is supplying the capital to invest into Japika because they need to do the IQY investment. And interesting of why they're two separate allocations, they solve two problems for the price of one. One is that they earn an 8% or so, depending on the structure, divvy yield off their investment. At the end of the period, they get their money back. But at the same time, they save money on their PPA, on their energy consumption. And I know this is a very busy slide. It's the last slide I'm going to talk to. But typically, this just models a 6 million rand investment. And the modeled internal rates of returns, typically depending on the specific nature of the client, sit somewhere between 17 and 20% per annum. Remember, you're making money from your investment into Japika, but you've also got energy saving through the PPA that you make, because you're saving money from your offtake from the municipality or Eskom. And so we're very excited by Japika. We think that's another great investment. So to bring it all together, current investment portfolio, we're comfortable with the way it's positioned. Some companies are doing really well. Some we're just waiting for the returns to come through. But in terms of the pipeline, we're very excited around the top up into B1SA, Ferocian social media risk business. We think that's a great opportunity. Maestro in the financial services space. Actually, interesting enough, when I look at our portfolios, we don't have a financial services type business in our portfolios. And so we think this gives us diversification from a business perspective. And then we're also looking from a green perspective at Mandini and at Japika. And so with that, I'm afraid because of some of the technical difficulties at the start, we run over a little bit on my time, but I'm going to hand back to Sipho, and we will try and squeeze some questions in before Sue gives her thank you.
Thank you for that, Geoff. And just to update you, I don't think they call it speed dating anymore. You just swipe left or swipe right. But yeah, don't want to expose your age there. Because of time, I think we'll just have a few questions that were then posted online. I'll ask maybe Alex just to respond to this one. The first one: how do we find out more about the financial freedom program for our staff? And the second one: political pundits seem to think that the GNU might fall apart at the 2026 local elections owing to a resurgent MK party. What will become the key coalition partner? If there is an MK-ANC coalition, what happens to our markets? I think maybe if you can just answer those two questions. What we will do is then just compile the rest of the questions in an FAQ format, and then just supply it out to all the participants on the call.
There we go. I'm unmuted. Thank you. Super. I'll address the second one first, if that's okay. It obviously
Fine.
wouldn't be good news for the market. And when I was chatting with France about this, he said the first battleground was the government election process, but the next one is going to be the local government elections, and there's the potential for there to be massive unrest. You know, where you've got people in parliament, they've got a term effectively, and at the end of that term, they become unemployed. And the people who are heading up the parties, they've got to find a place for those unemployed people. Now, the local government, they're not just 400 or 500 people, but there are thousands. There are a few thousand people in local government, and they have people they're supporting. They may be earning more than just their salaries. They might be earning from alternative sources. And those alternative sources potentially come to an end if they are no longer in power, which could lead to an enormous amount of unrest, which would not be good for the GNU, would not be good for the markets, would not be good for sentiment. So got a lot of excitement coming our way.
Most definitely.
In terms
and the
of finding
second
out more
question?
about the Financial Freedom Program, it's very easy. In fact, I'm happy that people on this call just reach out to me on my WealthBit address. So it's I'll put into the chat, or you can take it down and distribute it. So it's alex@wealthbit.co. So alex@wealthbit.co. And I think just mention Invequity in the subject line, because I'd like everyone to get some special treatment.
Okay. No, thank you for that, Alex. I think we will be sharing all the presentations. I'll hand over to Suhana, our Chief Operating Officer, just to close off this session.
Thank you, Sipho, and thank you for all of you for being here today. It was truly a pleasure to welcome you all back and have the opportunity to host you again this year. Trust that the seminar has both been positive and insightful, and that the discussions and presentations have provided valuable perspectives as we look ahead for the future. I'd like to take a moment to extend a special thank you to a few individuals who have played key roles in making this event possible. To Alex Cook, our esteemed guest speaker, your expertise and insights have been invaluable, and we're deeply grateful for the time and knowledge you've shared with us today. A very big thank you to our investors and clients. Your continued partnership as well is vital to our success, and we are very excited about the opportunities that lie ahead. To Geoff and Sipho, thank you for your engaging updates on the presentations on behalf of Invequity. Your contributions have been instrumental in shaping today's discussions. Heartfelt thank you to the Board of Directors and to Murray and the Signa Group for your ongoing support and collaboration. I would like to express my deepest gratitude to the entire Invequity team. Your hard work, your dedication and efforts behind the scenes have been exceptional, and you've played a critical role in ensuring today's seminar is successful. Once again, thank you to everyone who joined us today, and we wish you all a blessed, productive and successful remainder of 2024, and we look forward to continuing this journey together. Thank you.
Thank you, everyone.
Thank you, everyone.